things have played out the way pretty much we expected them to in December, as crazy as that sounds. We thought that the market was worried about a recession last year. We wouldn't get one. We would rally back to the highs, which we've done. But as you sit here now, upside and downside looks a little bit more balanced in the short run. We still think that the economy is going to reaccelerate at the end of the year. We don't think the bull market run is over. But at essentially 3,000 in the markets, we think that there's a little bit of opportunity for some disappointment over the summer. And so it's time to kind of put a couple chips in your pocket.
So with that being said, and the Fed being such a focus, how much are you as a portfolio manager moving around people's money going to pay attention to what Fed Chair Jay Powell will say later on this week during his congressional testimony?
I think this week is hugely important. And it's not just his testimony, which is going to be critical, but we also have PPI and CPI, which are the two biggest inflation readings that we have left ahead of the July meeting. Our view has always been that 50 basis points wasn't going to happen. So I think the jobs number, as disappointing as it was on Friday to the market, which is incredible to say that such a blowout jobs number was disappointing, it at least right-sized expectations back down to that 25 basis point cut. And given some soft inflation readings, if PPI and CPI come in, where they're expected to this week, we still think you'll get that. Will it be a short-term disappointment for the market? Potentially. But if there's weakness that comes out of that, that's something we would see as attractive.
In your mind, is it appropriate or at least the right thing to do for the Fed to cut interest rates at this stage?
I think it's a valid conversation. And I think, yes, it is, because what we think is going on is that you've got an underlying downward pressure on inflation. It's for a good reason. It's technology, it's automation, it's AI, it's driving down costs. If that's the case, the economy can run a little bit faster without generating inflation, and we can have rates a little bit lower. So I think that's a valid conversation. I don't think they need to rush in cutting 50, 75, 100 basis points because of some impending end of the world.
Do you feel as though there is political pressure being brought to bear on this? I mean, I bring this up because we do see Turkish President Erdogan firing, in essence, his central bank head. We know that Donald Trump, President Trump, has not been happy with interest rates the way that they are right now and has been publicly, at least, negative to Fed Chair Jay Powell. Is the Fed being influenced in your mind by this situation right now?
I hope not. I mean, job descriptions are a beautiful thing because they tell you what you should do and what you shouldn't do. And the Fed is supposed to focus on, price stability and full employment. And I think if Powell does that, then you let the rest of the chips fall where they may. But from his perspective, I think the best thing he can do is play the cards that he's dealt. And if there are downward pressures on inflation, the economy can run hotter without generating big inflation, then he should cut. And if not, he shouldn't. The president will do what the president does.
You and your team of analysts over at Federated look at valuations, and interest rates are central to that. The lower those interest rates go, the more you can pay for stocks, right? Because they're valued at slightly more given what they could do in the future. So are you of the mindset that stocks really do have a next leg higher because hypothetically the central bank could cut, as they have around the world, by the way?
I think it's a contributing factor. I don't think stocks are going to go higher just because of a cut. Our view is that bull markets end in recessions. And as long as the expansion continues, markets should continue to hit new highs. We do not foresee the ingredients for an impending recession. We think the expansion will last, and we think that a rate cut coupled with a trade deal and a still strong consumer could lead to a reacceleration of the economy. That's why we want to buy stocks. It's the reacceleration of the U.S. and global economy towards year end that gets us excited, not just the rate cut.
Just a bit left here. Are there places in the market you like better than others?
Yeah, small caps. It sounds crazy because it's late cycle, but 50% of their debt is variable rate, so lower rates help. They're cyclical, so they benefit from a pickup in economic activity that we foresee, and the IPO market's hot. And so if you can get exposure to some of these disruptive companies, it's great.